All right, in this video, we're going to be talking about the 4 ways to benefit from tax advantages in real estate. This is an in-depth video, so you're going to stay down to the end in order to understand the complete process and how this works. But in case you don't know, we're going over a 5-part series where we're talking about passive income, appreciation, tax benefits, massive income opportunities, and leverage. These are the 5 ways to make money in real estate. And if you follow all 5 of these ways, you're going to be much better off than investors that only make money off of one way in real estate. All right. With that being said, let's get right into the first topic, which is capital gains. All right. As we saw in previous videos, typically most properties do appreciate in value. Okay. If we sell them, we have to pay capital gains tax. But the benefit is it's a lower percentage rate than income tax. The less income we can make and the more capital gain we can make, the better off we are. Another thing that we can do is we can avoid taxes by using a 1031 tax deferred exchange. Okay, so we can sell properties and buy other properties with that money and not pay any taxes on that activity. Another thing we can do is use a homeowner deduction. Okay, there's 2 criterias. You must live in the home for 2 years of the last 5 years. So if you've been living in the home for 2 years and you haven't used this tax strategy in the last 5 years, you're eligible to do this over and over and over again. Which means if we live a 100-year lifespan, right, and of those 100 years, we're an adult for 80 of them and a homeowner for 80 of them, we could in theory do this, quite a few times. So with that being said, let's get right into how this works. So if we purchase a home for $100,000, okay, and it goes up in value to $600,000, okay, we would have to pay the capital gains tax on it if we were single, because single people get a $250,000 deduction and married people qualify for a $500,000 deduction, which means the difference between $600,000, which is our sale price, and our purchase price, or what is also known as our cost basis of $100,000, the difference between that and that is $500,000, meaning we can take advantage of the benefit if we're married. So that would, in theory, save us 20% of that difference, which is $500,000. Now, if we're doing a 1031 exchange as an investor who owns an income producing property, then what we need to do is we simply need to, we could do any amount. It really doesn't matter if it's 600,000, if it's $1 million. Okay. We can take this property, sell it, and purchase another property for $1 million, or we could purchase 3 properties, and as long as those 3 properties add up to $1 million, then we're all in the clear. Okay. So we just have to be able to use that money to purchase other properties, and we can avoid paying capital gains tax today and kick that bucket down the road. Now, you might be asking, why would you want to kick that bucket down the road? Well, there's a lot of reasons, but one reason, for example, is inheritance, right? So we'll go over that tax benefit right here. Okay, inheritance, meaning that one person purchases a property. Let's say an investment property. It was a home, and they had a renter that lived in the home, right? And they owned it for, a long time, for 50 years, and now it's worth $900,000, right? Because it's in Hawaii or someplace where prices rapidly appreciate in value, right? Well, if they were to sell that home, right, they can't move into it, live in it for 2 years and sell it for $900,000 and avoid taxes, even if they're married, because $900,000 minus $100,000 is $800,000, right? It's just too much money to work with a homeowner deduction. If they did a 1031 exchange, right, they would be able to avoid the capital gains tax on that, but essentially they would still be owning the exact same property. Well, if they were to put this property in a trust, right, pass it down to their children. Now, again, you're going to need a lawyer for that, and this is not a DIY video. This is just simply explaining the tax implications. And make sure that you contact a tax professional if you're doing your own taxes, because this is also not tax advice. This is just simply telling you on why people own property, okay? This is the why, this is not the how, okay? So if an event happens where somebody passes away, we have a $900,000 benefit, okay, to the beneficiary, the person who inherits it, right? Which means that this $100,000 cost basis goes away. It's as if a $900,000 gift was gifted to somebody. Okay. Now, if they were to sell it at $900,000, they would pay $0 in taxes for capital gains. If it goes up in value, let's just say up to $1 million, because some time has gone by, they would only pay the taxes on the difference between $900,000 and $1 million, not $100,000 and $1 million. So that's a lot of tax savings right there. And in this case, let's just say they asked their tenant to leave and they moved inside of that house and they lived in it for 2 years while it was appreciating up to $1 million. Then they would be able to capture that value if they were single, if they were married, right? Because we know that homeowners can live in a home, and as long as they don't sell more than one home every 5 years and they're living in it for at least 2 years, that they can actually benefit $250,000 for single people, right? And $500,000 for married people. All right, this is another one that benefits investors here, and that is depreciation. All right, depreciation is a tax benefit, right, that allows you to write off the building value, right, on your taxes. Now, we know that buildings generally go up in value, but what we can do is we can purchase a property for $200,000. Okay, and let's just make our math easy and say that the land is worth $100,000. So we subtract out $100,000 of land value, and what we have left is $100,000 for our building value. Okay, we can take this and divide by 27.5 years. Okay, and that leads us to roughly $3,600 in taxable income that we can write off every single year for 27.5 years. Okay, so again, if you want to apply this, contact your tax professional. But essentially, if you made $100,000 worth of income, right, and your tax rate was 40%, and you could subtract $3,600 off of that, and now you're only going to be taxed on $96,400, right? So essentially, if we're at the highest tax bracket, which I don't know if $100,000 is because I'm not a tax professional, but let's just say we're making a lot of money and we are in the highest tax bracket. We're paying about 40%, 36%, 35%. We're paying some high percentage in income tax, right? That leads us to a benefit of $1,400 and $1,440 every single year for 27.5 years, which is a really good reason to own this property, right? Now, what if we just said, hey, we're just going to look at it over the entire time? Well, if we just take 0.4, multiply it by $100,000, that's $40,000 worth of income tax that was converted into our cost basis decreasing, right? So we have an increase of taxes of $20,000 of capital gain that we're going to have to pay later on down the line. We don't have to pay it today, we can pay it later, which is a great benefit, right? So we converted $40,000 worth of income tax to $20,000 worth of capital gain tax. Even if we just sold the property, right? We didn't do a 1031 tax deferred exchange. We didn't live in it for 2 years, right? We still saved $20,000 in taxes, right? Just from this activity alone, right? And that's not even talking about the other tax benefits that we learned about earlier and how cap gains tax could actually be avoided if we did a 1031 exchange. All right, the last topic we're going to talk about is loans. All right, again, I'm not a loan officer. I do not write loans. I do not sell loans, okay? I'm not giving you loan advice here. What I'm telling you is that people do this, okay, and that it is possible to be done, okay? So again, this is not advice. I actually don't recommend that you do this, but it is something that can be done if you want to avoid taxes. So let's say we purchase a property for 200. Actually, we're going to make the numbers even easier. We're going to say we purchase a property for $100,000. Okay? And that loan value on it is $80,000. Okay? And it really doesn't matter what our loan payment is. Let's just say that rental rates were very competitive with loan payment rates, and that we are able to write off our, property taxes, maintenance, insurance, and our loan payment and most of our interest, and we're not paying a lot of income, right, for this property, right? So the benefit of that is we don't pay a lot of income tax. But let's just say over time this property goes up to $200,000. Okay? And so now we have a property that's more valuable, so the rent has gone up to compete with a $200,000 rent. Well, if our rent is double than what it used to be, then we have to pay that difference in taxes, right? So now we're paying a significant amount in taxes. Also, our loan amount has actually gone down a little bit over time too, right? Let's say that $80,000 loan is now $40,000, right? So we have less interest that we're paying in order to save on taxes. Again, I know might sound complicated. We're going to have a more in-depth video on loans later. We're just trying to give you the broad understanding of how this works, right? Just understand that if your loan balance is only $40,000 and your property value is $200,000, you are most likely paying a lot of money in income tax. So what can we do? Well, we can write a new loan on the property for $160,000. As you can imagine, our interest is going to go up, and that's going to avoid paying income tax, right? So now we're paying less income tax. We have less cash flow, right? Meaning that we are receiving less monthly profits on the property. But why would we do that? Well, this entire, right, $120,000, all right, is not a taxable event. Meaning that we could take that $120,000 and we could put that on a down payment on another $200,000 property and keep the cycle going over and over and over again. Okay, again, this is not advice. This is a very risky loan strategy because you're essentially giving up guaranteed monthly income for this, risk that the property is going to maintain its value and that you are going to continue to make those loan payments, which are much higher than where you had started with. So again, I don't necessarily recommend this, but it is something that you can do if you want to. So with that being said, those are the 4 ways that we can avoid paying taxes from owning real estate, right? We can essentially convert income into capital gains, right, which is a lower percentage. We can avoid paying capital gains because there's capital gains deferments and benefits to homeowners. We can inherit property. We can make passive income from essentially depreciating an income property that a tenant is living in and paying us rent for. And lastly, we can use leverage and loans in order to avoid paying some taxes in real estate. I hope you got something out of this video. I hope it motivates you to understand that there are a lot more benefits to owning real estate than simply just receiving rental income or just paying a little bit less per month to live in a home. Okay, there's a lot of benefits, and if you stick with this process, you're going to be much more wealthy than you could have ever imagined. All right, thank you very much, and have a great day.